So I think that clients overall we still retained over 99% of our client base. We actually only had 3 clients this whole year move to cash out of over 1,200. So an incredibly small percentage kind of freaked out and pulled the cord, which I think goes a long way to to say that we are. I think the clients have confidence in what we're doing and that it is predominantly working for them. So before that, let's kind of get started. Here we'll talk about the economy, talk about stocks, bonds, a little bit about policy, kind of at the end. But let's talk about the economy first, kind of the highest level. So first of all, we see that the United States, its annual forecast, the GDP is only to grow at 0.5%. That's slow. When people say, are you in a recession? I think the answer is probably yes already. But this 0.5% is basically showing a recession. So and I think what LPL thinks is that in the first couple, the first 6 months of the year are going to be the toughest months, kind of while the Federal Reserve is still raising rates before they stop, which we think will probably be in the spring. So as that's happening, we could get a couple of quarters of GDP contraction, which is a recession, right? We've already had a couple. They haven't been huge down quarters, but a growth of 0.5% reflects a couple of quarters of negative GDP and a couple of quarters of positive, right? And that's why you end up with that 0.5%. As you can see here in the Eurozone, no one expects the Eurozone to do much. Their inflation's too high. The war in the Ukraine has really affected them a lot, especially with energy prices. So it's tough to get natural gas across oceans. It's easy to get, they tend to be piped. They're not in big tankers historically like oil is. So there's some liquid natural gas boats. They're funny looking boats with little igloos on top of them, and they're these huge barges now that go out. But the first liquid natural gas boat to ever leave the U.S. shores was in like 2016. So it's really not something that has been happening for a long time. It's not something that's common, and there's not enough boats in the world to supply Europe with the oil that they need. I was actually there a couple months ago, and I was talking to some people, and they said that their actually monthly bills that they're paying for natural gas, and this was only in October, were already up 300% from the year before. And that's just wildly increased. So the problem with them is they're going to have higher inflation because of the war and because of their energy costs than we are. But their economy is also already was going a little slower than ours. So if you kind of take more inflation, it means they have to raise their interest rates more, which slows down their economy even more. So they're going to have a tougher job kind of landing the inflation bird, I think, than we are. If you average those two together, of course, you get 0.4 for advanced economies. But look at global markets and emerging markets. They were underperformers this year, but basically because of currency. The U.S. was raising rates quickly to try to beat inflation faster than most of the rest of the world. So the interest rates are higher here. So how I always explain to think about that is think you're a sheik in Saudi Arabia, and you made an extra $1 billion today on the sale of oil, and you wanted to put that money somewhere. Are you going to put it in Japan and earn 0? Are you going to put it in Switzerland and potentially earn negative? Are you going to put it in Germany and earn 1%? Or are you going to put it into the US and earn 4%? Right? Well, of course, the answer is that they're going to put the money in the US and earn 4%. So that kind of drove the dollar higher and higher, because as people put their money into the dollar, the demand for dollars rises. Well, if you think about it in this way, most of the, for the people that live around here, we understand, Canada, right? It's close. If you were going to buy a cottage on Lake St. Clair on the Canadian side for $100,000 a year ago, today, because the dollar has appreciated so much, it would only cost $85,000 because the dollar's up about 15% against the Canadian dollar. So that Canadian is still getting 100,000 Canadian, but it's only costing us $85,000, right? Not 100, right? So as the US dollar goes up, international assets seem more reasonable to us, even though they haven't changed in real terms, but that shows up as negatives on our investment statements. So hopefully that the fact that the dollar is coming down, the Federal Reserve has already slowed their pace of increases. Hopefully that will continue to 25 basis points on February 1st. There's a big inflation number out tomorrow that will basically tell us whether or not it's going to be 0.5 or 0.25 in February. So we'll be excited about that for the morning. But if it's only 0.25, that's going to really start to slow and stop what the Federal Reserve is doing. That's going to mean our interest rates will all come down. And then hopefully some of these global markets who are actually growing faster than us, and the companies are growing faster than ours, will turn back and have a good year. We'll talk about that a little bit later on. Leading indicators. So leading indicators, like when you look at GDP showed what we happened, 3 to 6 months ago, right? You look at the last quarter of GDP, and the last quarter of GDP is based on stuff that happened the quarter before that. Leading indicators, on the other hand, are things that you can look at that determine what the future, the next 3 months to 12 months should look like. What I like about this chart is it shows the leading economic index and financial obligations ratio. Kind of think of these as recessions. As the leading indicators start to go way down, you get a recession. Leading indicator goes way down, even though it was short, you get a recession. Leading indicator goes way down, recession. Again, the leading indicator goes from here to here, then back up, then dips again, you get 2 recessions. So when the leading indicators look bad, it usually means recession, which I think that we're either in, like I said before, that we probably will be in the first half of this year. But what I think is important to that is the stock market usually bottoms long before the big recession kicks in. So hopefully what's already happened is the stock market has hit its bottom at 3,500 and change for the S&P. It's up to almost 4,000 as of today. That's a pretty big jump, right? Of what? This would be 13 to 15%. Now we're still 20% below where we were last year. But even if we get a mild recession, as these leading indicators are pointing, and something called the yield curve is pointing to that. I mean, kind of everything's pointing towards a mild recession. As that happens in this instance, and this is not always true, but in this instance, what that could mean is that, housing comes down, but not a lot, not 08, right? 5 or 10%. Specifically in the hotter markets like Phoenix, actually Boise, Idaho, places like that are very popular as people are moving out of California. So as these kind of like boom towns start to slow down, they'll come down more than we will here in Michigan. Unemployment will get worse, right? It's at 3.5% now, and that's bad, right? And we'll talk about that in a second. I've got a good slide for it, but there's only 3.5% unemployment that drives inflation up. We don't want that. We need about 4 million people to get laid off, right? That's what the economy needs to kind of get back to healthy, as I'll show you in a little bit. So what this could mean, and this is the difference when you hear between a soft and a hard landing. If the leading economic indicators are going down and the actual economy then goes down, that could get inflation under control, which will then cause the Federal Reserve to lower interest rates, which is very stimulative and could be excellent for the stock market. So when people ask me, are we in a recession? I don't even think they're asking the right question. I think what they're asking is the slowdown going to be so severe that it hurts the stock market? Or is the slowdown going to be such to where it's kind of a soft landing? The Federal Reserve then stops and then decreases interest rates and inflation is under control because the economy is a little bit weaker. And I think probably the most likely case is that, right? So this is driving inflation almost predominantly at this point, which is this is the amount of jobs open for every person who's looking for a job, right? I mean, you can see out here, when you only have, 0.5 or 0.25 jobs open for every one person who's looking, right? Well, that of course means 3 of the 4 people who are looking for that job are not going to get one, right? Now that might be bad for those 3 people, but for the people on this webinar who either all have jobs or are retired, it's very positive because it means wages can't get crazy, because if wages go up too much, people have that money to spend, they start buying stuff, there's shortages, and then you get inflation. So this is bad, right? We do not want there to be 1.7 or 1.75 jobs for every one person that's looking. That means if the dumbest, laziest, worst employee, right, and everyone else got a job, and that guy finally got a job, it would mean that you still have a ton of open jobs, right? You would go down from 1.7 to 0.7. There'd still be 0.7 jobs. I mean, it would be terrible. So this is bad. So this is why when I say we need layoffs, I don't want to, if anyone on this call or any of your friends get laid off in the next couple of months, I'm going to feel bad about this. But it is, again, it might be bad for them, but it's the best thing for the economy. The best thing that could happen is about 4 million layoffs from an economic perspective, because the Federal Reserve would think inflation was basically over. The numbers are already coming down enough to where they believe it. They're just worried about, they're worried about this, right? The actual inflation number, again, what we look at, what I think most people here probably on the webinar look at, is more of like an average in the last year, right? And it kind of went up to 9.1. It's back down to about 7.4. But if you look at the last 3 months, there's been almost zero inflation. It's actually been below what the Federal Reserve wants. So I think when the Federal Reserve looks at it, which again, the whole economy is determined on what they do at this point, right? A year ago, it was interest rates. What was going to happen with interest rates is all I talked about. Now, all that matters is what the Fed does with those interest rates. So when the Fed sees this, they say, you know, inflation looks a lot better, but I can't lower rates because there's way too many people working. Wage gains are going to be there. People are going to have way too much money. They're going to spend it and create inflation again. And then we've got to have this constant seesaw. When this number comes back down, you know, I'd even be fine with 1, right? But about 0.7 is healthy as an economy. You know, but that requires millions of layoffs. But if that happens, that's good. So this drop that we've seen is wonderful for the economy. Housing was super expensive. Rents went up, interest rates went up, the prices of houses have gone up. I read a stat the other day that said that if you include the home price increase and the interest rate increase and assume a 20% down payment, the cost of a home, as far as cash flow is concerned for people's budgets, is up 60% in the last 2 years, right? That is absurd, and no one can buy a house, right? I mean, that's crazy. So you can see here that housing kind of got super expensive. You know, historically, people can only pay so much as a percentage of what they spend on housing, right? And you can see that number is usually around 1/3. So people spend about 1/3 of their money on housing. They can't, you know, these numbers, right? 35, 36%. It might not seem like a big difference, but it makes a huge difference to the consumer, right? So also, as the housing prices come down, which they already have pretty substantially, as if we can get the Fed to stop raising rates and interest rates come back down a little bit, housing falls off maybe 5 or 10%, this number starts to look a lot better. Again, this is the stuff the Fed looks at to where we can then say, okay, stop raising rates. And when I say stop raising rates, I think this year they'll stop, I think in the spring, but I don't think they'll start lowering them until you see housing and unemployment go up, right? Less people have jobs and housing come down a little bit. When you see that, the Federal Reserve's terminal rate, meaning the interest rate that they usually have, is like 2.5 on average over the last 40 years. Well, they're already over 4, and they're planning on going to at least 5, if not 5.5. That is way too high in a typical functioning economy. There's no way they're going to keep them that high. So the question is not, are they going to stop? Because I think they will. And the question is not, are they going to lower it? Because they're going to have to. But the question is, when is that going to happen? If that happens this year, the stock market is going to skyrocket. If that happens next year, the skyrocket's going to do okay this year, but not skyrocket. And let's start kind of talking about that a little bit. Yeah, everyone knows who's been doing these for a while now that I love little statistics like this. So after the Fed stops raising rates, what happens with the stock market? All right, I think it's a wonderful question. Actually, some people asked me and I didn't know. I had to look this up. So here in 1974, is a long time ago, before I was born now. You know, there must have been something, there was a stagflation in the 70s, I know, but there's something happened where the Fed stopped raising rates and the stock market still went down, not only for 3, but also 6 and a year out. But almost every other time that the Fed stops raising rates since 1974 on, you know, so that's a long time, it's almost 50 years. Unless the economy is in a big recession. So in 81, people probably remember that a lot around here. Because it was such a bad time for the Michigan economy. So there was a big recession going on. So the Fed raised rates, got inflation down, stopped the stagflation of the 70s, but it created a big recession. So even though they stopped raising rates, the stock market still didn't do well. But it also didn't go down 30% either, right? It was up for a couple months. It was down a little bit for 6 months, but then a year out, you know, it was down about 10%. But you look at 89, 95, 06, 8, and 18, these are all times that we were not in a big recession. And look how great the stock market did in the next, I mean, there's, what's this number? About 20%, maybe 27%, probably 33%, you know, this year. So we're talking huge gains. Now, I don't expect gains like that to happen this year, but that doesn't change that this is what the numbers are, right? So again, unless you're in a big recession, 2000 was a pretty big recession. Right, 2000 and then September 11th, right after, that was a big recession. So the stock market was not good after. 81 was a big recession, the stock market wasn't good after. But all of the other times the Fed has stopped raising rates, the stock market has completely skyrocketed after. unless we're in a big recession. What I'm hoping is we're in a small recession for 6 months and then some expansion for 6 months, and there can be some growth. Here are the down years. So Federal Reserve, I think, is one thing to look at. Another thing to look at is after a bad year, what usually happens in the stock market. I would consider last year a very bad year. So after a bad year, what usually happens? So here's the calendar return for the S&P 500, and then the orange is the following year. This is every year, so all the way back to the 50s, that the stock market was down in a given year. That's what I said when we were down 20%. Like, look, there's not a lot of these, right? I mean, this one's not even quite there. I mean, we're talking 3 other times ever in the, in modern history. I would say post World War II is modern history. In modern history, this was like the 4th worst year in the stock market. Right, so it was bad. So what happened after those years? Well, only 3 times did the stock market go down. Again, 2 of them were that 2000, 2001 huge recession / September 11th, right? So these are down, and that could happen. Russia nukes Kiev, however you say it now, right? That something like that is like a black swan event that no one, I don't think we can predict. So there's a couple things out there that could happen, but short of a gigantic recession / geopolitical issue like September 11th. Again, there must have been a big recession in 73 and 74. I know it was just part of the kind of overall 70s stagflation. But the stock market was down way, it was down a ton after another bad year. I mean, that's a 50% drop in 2 years. But look at all these other years, and these are not small gains, right? 45%. I mean, that's, again, don't expect that. That's ludicrous. What, almost 40%, a lot around the 20 range. So after a bad year, this is usually what happens to the stock market. Again, here's the average. And what does that average look like? Probably somewhere in the neighborhood of 17, 18% average positive rate of return. That includes a couple of the big negatives. So I think that was pretty encouraging. Stock market earnings. So last year, they said, hey, the year kind of started off really good in the first quarter. So they started to think earnings per share was going to be close to 230. It ended up being 222, and it started the year 220. So it grew a little, right? You had a little bit of growth in what the S&P 500 companies were making, but not a lot. That number actually surprises most people, though, because I say the stock market, the S&P 500 was down 20%, but its earnings were up, right? It actually made about 3% more. If you kind of take out some of the noise in this graph, it made about 3% more than it made the year before, yet the stock market was down 20%. What that shows me is that the multiples have contracted. Then I'm going to see how I'm doing on time here. Okay. So I don't have time to talk about it too much today, but it's basically what you're willing to pay for a company if the interest rates are 0 is a lot. Because even if you buy that company, you think it's going to grow at 5% a year, it's a lot more than 0 in your bank or in a bond. But when bond rates go to 4.5% or CD rates go to 4, or money markets, there's some out there that are like 3.5 or 4. Well, now you can't get 5 in the stock market, and no one will do that, right? So you need to get like 8 or 10% in the stock market. So that's called the expected gain. So what happens is that the price you would otherwise pay for a stock is less because your alternative investments, money markets or bonds, look much better. So there's no way you would take 5% of your growth in the stock market if bonds are at 4, but you would take 5% of the stock market if bonds are at 0. So as interest rates have come up, what we're willing to pay for a company, right, even though they have more income than they had a year ago, is less, right? Because our alternative options look a lot better. And then here are the estimates from last year. They actually came down a lot, right? So they thought 2023 was going to be more like 250. No, it's probably going to be in like the 232, 235 range. Again, still an increase from 222 to 232, but way down from the estimates earlier on in the year of about 250. What's nice is this is more, right? This means LPL research, and this is it's not done by, this is a survey of all of what everyone thinks. This is not just LPL, kind of what all the companies think earnings are going to be. They put it into an average, and that's what they give us. So what they're saying is that companies should make some more money is kind of their base case. And then that should lead to, assuming multiples stay the same, that should lead to some growth. I like this a lot. I'm going to go a little bit more slowly on this. This is, I think, the base case. This was put together about a month ago because they had the Outlook 2023 ready. So this bull case is already not going to happen because the Fed did not signal a pause before the end of 2022. So this bull case of 25%, that might have been true a month ago. That's probably 5% today, and that's my guess. I don't think a lot of this stuff is going to happen in here. And I definitely don't think the stock market's going to end the year at 5,100. So I think that this bull case is wrong, right? Is wrong at this point. It might have been a potential a month ago, but it's not now. The bear case, I also think, is probably about right. There's probably somewhere between a 5 and a 15% chance that we get into a recession. Inflation remains really high. Interest rates actually go up more than we think. The Fed continues to raise rates into 23. And that kind of recession will drive huge earnings drops, right? Because that would be a problem. Everyone is fighting. US and China, Russia, Ukraine is a problem. They nuke Kyiv. And multiples contract even more than the 20% they did this year, and they contract about another 5 or 10%. And we would end the year at 3,700. That sounds very unlikely to me as well, quite frankly. Again, so what I think is probably more likely to happen, and I think this number is probably more like, probably 85% in this case, is the economy, again, is kind of flattish growth, right? We're not, the 222 to 232 of growth, that's less than 5%. So very slow growth, throw in a little bit of a recession. Inflation goes down across the globe. Again, it's been basically zero in the US for like the last 3 months. So that's already happening, and I think it continues to. Interest rates, again, they move gradually lower, not a big change. The Fed stops raising rates in spring of 23, I think is the most likely case. They've basically told us with the terminal rate is kind of the highest rate that they want. And if they do 3 more 25 basis point raises, they'll be there. So that's why again, we'll see tomorrow will be a big deal what the CPI says, but I think that's probably the most likely. Earnings are going to not do that well. We expect them to grow a little bit. China they've already kind of reversed, and this is before China reversed their zero COVID policy. They're already reversing it. So that's going to help a lot as far as like what they're consuming as well as the supply chain. PE again goes up a little bit. Estimated PE of 18 is about, in the ballpark. And I think that might be slightly rosy, but not that much. Again, earnings per share, they're staying here, kind of stays stagnant. But we end the year at 43.20. If we end the year at 43.20, that's about 10% growth from where we are today. I think that's probably a little bit optimistic. I think we'll probably get almost no growth the first 3 to 6 months. And I think after that, maybe we could get a 6 or 8%, but it will all be, predominantly be in the second half of the year. Again, this is crazy. A PE of 20 is just literally never going to happen. Bonds, as we talked about, bonds had their worst year ever. I read the other day that the worst year ever for bonds was a 4.5% decline ever in 200 years of the financial marketplace, where this year they were down more like 12. So it was a bloodbath in bonds. Luckily, interest rates are coming back down, and that's helping a lot. Again, what's probably going to happen with bonds, and I think that, back to the mild recession, the economy grows a little, nothing to jump up and down about. Inflation moderates as it already has been. The Fed, see, when they say Fed cut rates but are still restrictive, I don't think they're going to cut rates this year. But I also don't think they're gonna hike, right? They're not gonna raise them anymore. They'll go to a certain amount and they'll be fine. And then they're the global bonds will kind of even out, and the 10-year Treasury is going to end up at 3.2 to 3.7. That's where we are today. We're at 3.5 today. Again, down from about 4.2. So that takes me to like, well, what does that mean for bonds? Well, again, so if interest rates don't really change that much, which we don't think they're going to change almost at all, these are the estimated rates of return for bonds based on that. Remember, bond rates of return are a mathematical certainty, assuming that the projection is correct, right? So if there is no change, these bond returns aren't an estimate like the stock market is. They are how they will perform. Now, again, your assumption could be off though. So here's changes in interest rates this way and changes in interest rates this way. So if the 10-year Treasury drops 1% down to 2.5, which again, I do not think is going to happen, bonds will return 12%, right? We know that that's math. Because again, it's not an auction-based market like our houses or the stock market. So I think bonds, again, where I was terrified of bonds for the last 2 years, and we really did our best to do alternative things to them as much as we could. The problem is bonds are very liquid. So for people that needed or wanted liquidity, instead of to lock up their money for several years, they were in bonds, and they did not do well last year as far as a conservative investment is concerned. But I've changed my tune. I don't dislike bonds anywhere near as much as I have over the last couple of years. Again, bonds did much worse last year than I thought they would because interest rates went way higher, but that's coming down. Even if it doesn't come down anymore and just stays, those bonds are earning interest now, right? So these are the estimated rates of return in the bond portion of your portfolio. I'm not going to spend too much time on that because I think I'm already nearing a half an hour. So basically, though, a lot of people, clients ask smart questions all the time, right? One of them is Jason, as these interest rates go up, how is this going to affect, corporations? Like, what are they going to do? I have some thoughts on that. In 2023, the companies don't really have to turn over their debt, right? Meaning they've got some debt, very little of it matures, and they're just going to keep paying the interest that they've been paying. So we don't think the fact that interest rates are higher is necessarily going to hurt companies that bad that have some debt. The problem are these years. Companies' debts are usually shorter term, so there's a lot of money coming due, right? I mean, you're talking over $500 billion a year for almost 5 years after next year. So if rates stay high, those companies are going to refinance those debts, right? And they're going to have to pay that higher interest rate. And that's going to hurt earnings to be bad for the stock market. What I think could happen, though, and I kind of put my CFO hat on here of a Fortune 500 company. If I was a Fortune 500 company and I had earnings going up and I had solid profits, instead of doing stock buybacks, which the Democrats could add a tax to this year, instead of those stock buybacks, they could go just to paying off debt instead. Right? There's trillions of dollars going to stock buybacks. If they just moved a portion of that over to paying off debt, they wouldn't have a lot of these problems. And what companies were doing 2 years ago is they would actually like I think it was Microsoft was giving like a 5% dividend yield. Well, they could go borrow money at 2%. So they did a ton of debt, got that money and bought their stock back so they wouldn't have to pay the dividends out. Well, they can either sell that stock, right? Or just their new profits could go down to paying off that debt that they incurred. So actually a surprising amount of people kind of ask about this, and which is why I included it. Geopolitics, I'm not going to spend too much time on. The bottom line is China. China's been growing slow, and they did too many shutdowns for COVID. As you can see, as China's growth kind of goes up, commodities go up, which is bad, right, for inflation. China slows down the orange, the blue commodities slow down. China comes up, commodities come up, right? It's very consistent. Even China kind of stays the same, commodities go way down. Because if China's not growing, it doesn't demand all of those things. Then the commodity prices can come down, which again is good for inflation and can get those interest rates down faster. Then again, China grew a ton after COVID, and now look at where their GDP is, right? Way back down. And so what happened to commodity prices as this was happening to China? This was happening to commodity prices. Now this is happening to China. Commodities have come down some, but not all that much, right? So again, if China opens up and grows quickly again, commodity prices will probably stay the same, maybe go up a little bit. But if China continues, at a sub 5% growth, right? Look up here, when China was at an 8% growth rate, commodities went way down. If China's only growing at, if the US is growing at 0.5% and China's growing at 4%, commodity prices have a lot of room, I would think, to drop, which would be great for inflation. So I think that's a lot of geopolitics. Politics, all of you, every single one of you, and all clients, all 1,200 clients of Quest Wealth, you talk about politics a lot, right? And so I always include stuff like this because everyone is part of this issue. So if the average, so this is stocks after the midterms, stocks have always gained since World War II. Always, never ever have they been even or down. Right? The stock market is always positive after a midterm. And everyone, of course, says, well, depending on what side of the aisle you're on, you already think the other side stinks and doesn't. The results are almost the exact same, right? 14.5% if you're a Democrat, 14.8% if you're a Republican, right? So the bottom line is no matter who's president, the year after a midterm, the market averages a 15% rate of return. Right? And then you start to consider this with some of those other things we already talked about. How about the year after the Fed stops tightening? I think the average is like 8%. How about a year after a down year? The average is like another 10%. So again, I don't know that we're going to see all of these big double-digit returns. Again, I wouldn't think so. I would think more like I would probably think 7 to 9% before I would think 8 to 10 or maybe even 6 to 8. But the numbers are really all on our side, like really strongly. How about we just had a midterm election. How about midterm elections? So this is a Democratic president with Republican, so Democratic president is blue. And if they have a Democrat Congress, Republican Congress, or split. Now today, it's hard to tell which one we really have. We technically have split, right? Democrats in the Senate, Republicans in the House, but not really, because Sinema and Manchin vote with the Republicans so much, but they caucus with the Democrats, right? They call themselves Democrats. So I would say that we're probably closer to this, which is the Democratic president and a Republican, and a Republican Congress, because again, they have the House clearly. Now we'll see if they can figure that out. It was like they voted for McCarthy like more times since like the Civil War. So it doesn't seem like they're all on the same page, and with their slim majority, we'll see if they can get anything done. And then, again, the Senate is so close, and kind of the last two votes are not predictable, in Manchin and Sinema. So I think we're probably closer to this, maybe edging towards this, but we don't have this. So going historically since World War II, where have we been? We've been basically between 16 and 18% growth. When you have a Democratic president and this Congress. Again, if you have a Republican president, which we don't have, here are the returns. So with that, I'm going to answer. I know there's a couple chats. How you guys can answer questions is it's tough to see everyone on here, but you can unmute and ask. And I'm going to read I'm going to read the chat first. Let's see what question that is. So you guys can type it into the chat box or just unmute yourself and ask. Yeah, I mean, it's a good question, the debt ceiling. I've been worried about the debt ceiling for like a decade, right? I mean, so I'm pretty fiscally conservative. I don't think the debt ceiling discussions are going to really lead to that much because they always seem to lead to nothing, right? So it's not that I'm not worried about it. It's just that it always seems to get extended, because if it doesn't get extended, the negative impacts are so high. But there's been a couple of times where we've blown past an extension date. And again, it just really wasn't that big of a deal in the market. So, I mean, as far as like a really short-term thing that you could trade on, like in your own personal account or like some hedge fund somewhere, maybe. But from an overall like macro perspective of how we're going to do in the next 3, 6, or 12 months, I don't know that really matters that much. But Jim, if you want to ask another, if you want to chat in again and ask a secondary question or unmute, you're more than welcome. So as I wait to see if anyone unmutes, I'd say in summary, we think bonds, depending on, really conservative ones to really aggressive ones, will do 5 to 7%. We think the stock market will probably do 6 to 9, depending on how it really based on all the interest rates. So everything is determinant on the Federal Reserve and what they do with interest rates, right? The best thing that can happen is commodities come down, housing drops 5 or 10%, and 4 million people get laid off. If that happens, the stock market could maybe get, above that 4,400 level to maybe 4,600, right? And instead of 10%, we could maybe get 15% growth. Because if the Federal Reserve turns around and says, okay, everyone got laid off, housing is down, core inflation is already much lower than it was, and commodities are down, what is going to cause more inflation in the future? The answer is nothing. And they're going to say, well, 5 or 5.5% of a rate is way too high. Our target is more like 2.5. Now they can raise rates, or they can decrease rates a lot, right? From 5.5 to 2.5 is a huge reduction. As that happens, then now everything just can boom and take off, right? We've kind of like gone through the COVID. We're scared. Let's fiscally stimulate everything a ton. And the stock market went way down too much, way up too much. And as soon as the Federal Reserve can get back down to 2.5% interest, it's kind of like all of that just got washed out. We're back to where we belong, and we can begin to move forward. So if that could happen by the end of the year, I'd be ecstatic. And let me see if I can get to, so that was kind of in summary here. If there's anyone who wants to unmute, kind of speak now, I'll give everyone maybe another 30 seconds to do so, or chat. I haven't seen any other chats come through. And listen, my kids are at soccer practice, so I got at least 15 more minutes, so don't hesitate. Okay, all right, we got another chat here. Oh, thanks, Mary. Happy New Year. Okay, well, if that's it, I just want to thank everyone so much for taking the time to be on this. I always really appreciate it. Oh, wait, here's one. No, there's a question of what do you see with the impact of the BRICS nations kind of going away from the dollar? In probably the lifetime of anyone over 60, nothing, right? The US dollar is so dominant everywhere. And the companies, the countries that are trying to move away from it are just going into things that don't make any sense, like cryptocurrency, right? Or they'll do, they're trying to create a whole nother basket, but what's that basket going to be? The pound sterling? Pound sterling's in the toilet. It looks terrible. The Swiss franc is way too small of an economy to use as a reserve currency. What the Chinese communist manipulated renminbi, right? No one trusts that or trusts them, right? Who's going to use that as a reserve currency? So, I mean, I'm just not that worried about moving away from the dollar at this point. Where I would be worried, and again, it's again just not in most people's lifetimes that are clients of ours, but maybe 25 or 30 years from now, the US used to be 50% of the global economy. Now it's like 20, 25. If that number starts to get way lower, right? And we're like 10% of the world economy because everyone else has grown so much. Now you could start to talk about, okay, well, maybe there's a different reserve currency than the dollar. Maybe it's like the Eurozone. Most people don't really realize the Eurozone is a lot bigger than the US. Even without the UK, England kind of did their Brexit thing. Even without them, they've got 500 million people. Right? They have 500 million people. We only have 330 million. They've got a lot more people, and their economy is bigger than ours. We're still bigger per capita, but theirs is bigger than ours. So, China maybe gets its act together, and I just can't see that with a communist regime, but where you could kind of move away from the dollar to like a basket of currencies that included maybe the yen, maybe the euro, and things like that. But I'm just not worried about that yet because there's no good alternative, Gordon. And if you had some cash to invest now, where would you put it? Bonds or somewhere different? That's a really good question. I think bonds are going to have a good year. If you needed the money in the short term, let's say 2 or 3 years, I think bonds would be perfectly reasonable. If you needed money more long term, I would probably, again, there's some tail risk there. So I would probably do something maybe with some downside protection. We just did a custom structured note for this month where it was over 18 months. You could earn 2 times whatever the stock market does, up to 21.5%. Meaning if the market goes up 11, right, you would get 2 times that, so you get 22, but you can't get 22 because your max is only 21.5. So you get 2 times whatever the S&P does, up to 21.5. But the first 10% of losses were covered, right? So the structured note mitigates that. Now that's not an annual return because it's over 1.5 years. So don't think that's 20%. But over the next 18 months, if the market goes down 10%, you lose nothing. Goes down 11, you lose 1, right? And then so on and so forth. But on the upside, if the market even just does okay and goes up 10 or 11, you get 20. Right. So I think that that's all based on options pricing. The options pricing right now is as good as it's basically ever been in my career. And so we're doing a lot of things like that have a lot of upside, but also have upside that does well if the market only does okay. And then if we happen to get into a bigger recession than we think, and the market goes down another 10 or 15% from here, which we think would be like 10 would be by the max it would go down, you're protected anyway. So there's a lot of things like that. So I think, Aaron, it depends on the length of the time of your goal. What I don't like about bonds is you could go get a money market right now for basically what a bond is paying with none of the risk of interest rates moving. All right. So if we're wrong on rates, inflation keeps going up and rates go up more, bonds won't do as well. But that money market will still be there, paying you 4%. So I don't know if I'd go into bonds over a money market for short-term stuff. And I don't know if I necessarily put a bunch of new money into bonds if I had maybe like a 5-year goal plus or even an 18-month one. So I think bonds have a place in a portfolio as far as a liquid, because it's liquid and it can hold up the portfolio. But yeah, I don't know that I'd put a bunch into it just because they may do well. So if anyone has any, I'm going to see if there's any secondary questions, if I did a bad job answering them or you want anything else. Jim, I also saw you had your hand up for a second. If you do, just unmute yourself or send in another chat and just ask your question. Go ahead.
Can you hear me now?
Yeah.
Okay, I was not trying to put my hand up. I was trying to clap. Good job. Thank you very much for taking the time to do this.
All right. Thank you very much. I appreciate that. Well, okay. Well, to everyone, thank you so much for your time. I really appreciate it. Oh, wait, hold on. We just got another group position. Any thoughts on performance of different stock market sectors moving forward? Lawrence, I do. I can send you, if you want, email me. I can send you the LPL, kind of like the LPL. They have like a sector analysis on what they think is going to do well. It's got like a little heat map, which is pretty good. So I think that might be a little bit beyond kind of the overall presentation. But if you shoot me an email with that same question, I'll respond to it with the LPL research.
Great. Thanks, Jason. Appreciate the
No
presentation.
problem, man. Happy New Year. All right, everyone. Well, thank you so much. Have a wonderful evening. And remember, we do these quarterly. We always put the replay on our website as well as on our YouTube channel. So if you ever want to, if you forget what we talked about, you thought there was something that was valuable, you can always look back at it. It takes about a week or so to get it up through compliance, but that should be there. And then we do these quarterly. So don't ever hesitate to log in or grab the replay on those sources. Thanks again, and have a good one.
Thank you.
Thank you.
Thank you, Jason.
Yep. See you, Jack.